Hi there YouTube and welcome back to the channel. In this video, I want to talk about what is a Streamline mortgage, which program does that specifically refer to, and how do they work when you're trying to do one with your current mortgage company versus another one that you're not serviced with. But before we get started, if you guys are enjoying the content and the channel, please subscribe, like this video, share it as well, and comment for anything else you would like to add. And with that being said, let's go ahead and talk about Streamline. So, two things need to come into mind when we hear the word Streamline. First is basically we're looking to refinance a mortgage, and B, we're looking to refinance a government type mortgage program. The most common one you're going to find is FHA. We're looking to streamline. Other ones that are available out there that you typically run into is going to be USDA Streamline and VA IRRRLs. But for the purpose of this video, we're going to talk about how to streamline an FHA with a current servicing company versus going with another mortgage company. So when you go about doing an FHA streamline, what you're technically doing is you're changing the rate and you're changing the term of the mortgage. That's the only thing you can do. Now, the nice thing about FHA streamline is that it's easier to qualify because you don't need to pull credit. There's no appraisal report needed, and income calculation is not required as well. Now, on the flip side, there is a very big challenge to the loan advisor and the client. You cannot roll any closing costs into the new loan. So basically, we need to find a different way to cover these costs. The biggest reason is because most clients don't have the ability to bring $5,000 to $10,000 worth of cash to close to offset those closing costs. The only thing that can be rolled into the loan is essentially the FHA mortgage insurance premium. And here's some of the solutions we have available to help us cover the closing costs. So the first option is to work with a specific area of interest rates. Certain rates in the market, usually on the higher side of it, are going to come with what's called lender credit. Now that lender credit can then be applied towards the closing costs because that's a form of cash we're getting back. So meaning the higher interest rate you're choosing to take for the mortgage, the larger the lender credit is going to be to help and offset the closing costs. The second option we have here is mortgage insurance premium refund. When we're doing an FHA streamline, within the first 3 years of the mortgage, since it got funded, we have the ability to get a refund for the mortgage premium we paid for when we took out the loan. The refund has to do with the date of origination, balance, note rate, and some additional info that goes into that calculation to figure out how much we're going to get back. But we can use that amount to apply towards the closing costs. And our third and last option is looking into an escrow refund. So by building a brand new mortgage, doing this FHA streamline, we're going to close on the escrow account that we have, and all the money that's in there is going to come out in a form of a refund that we can apply towards the closing cost. Now, lots of times it happens when combining all of these refunds, there's still some money left that's needed for closing. In that particular scenario, we would build the loan to where the cash needed for closing is very similar to the monthly payment as best as we can. So with proper timeline of when we close, instead of having the regular monthly payment to the mortgage, we have the closing cost payment instead. And moving on from our scenario of doing an FHA streamline with your current servicing company, let's take a look as to how we do it with a different company. So the nice thing about this is because it's a government type mortgage program, the conditions that we need are going to be the same, meaning the conditions to qualify. So no closing costs can be rolled into the loan. The only two things that are going to be different here when we're doing an FHA streamline with another mortgage company is that the loan advisor at that company is going to need to pull credit. We need to verify that credit qualifies for that program. The second thing we're going to be doing is employment verification. We need to verify that the client has a source of income. We're not calculating their debt to income, just verifying a source of income that they have. Now remember, the mortgage company is going to assume a new loan and a new client. They will need some form of risk assessment in place. So in conclusion, guys, doing an FHA streamline is going to be pretty much across the board, the same everywhere a client goes to. It is going to be a little bit easier when doing it with the current mortgage company because they're already servicing that mortgage. Now, overall, streamlines are faster in processing times and are much easier to work with because, again, we don't need any income or appraisal reports. And that's all I got. So thank you guys for joining the channel and watching the video. Please click to subscribe, like the video, and add a comment for anything related to the topic you'd like to share. Thanks again and see you in the next one.